there's two types of the investments. You've obviously got the financial, where they just throw the money in, and then obviously we've got our strategic investors. Now, I know what my preference is, so I'm going to not give my view on, obviously. But what's the do you think that for a insurtech that raising a Series A, for example, there's a preference, or is it just about getting the money over the line?
Right. So, I think the sort of typical thinking is, in any kind of evolution of a startup, is get financial investors in early, and then you bring the strategics in later on, either as a Series C, Series D investor, or as the ultimate acquirer. I mean, that's the conventional thinking, and that was the case in Ian's example with Silver Lake, where a financial investor acquired Skype and then sold it to a strategic. But our thinking is that there's actually some merit in having strategics coming in earlier, rather than later. And again, it's probably based on the fact that you've got different types of strategic investors. Traditionally, your strategic investor invested from their own balance sheet, and it was with a view to ultimately acquire you. There could be issues around conflict of interest. Maybe that strategic could be competing with potential customers, and it could also limit your exit opportunities, as well as, to some extent, the valuation as well. Although some people may prefer that. They may say, we've got a set sort of exit pathway, and all we have to do is march towards that. So it's horses for courses. But the point is, with holding companies and CVCs now also investing as strategic investors, I think it changes the game a little bit. So a CVC is a corporate venture capital firm. They're typically the LP, or the limited partner providing the funding into the fund, is in the sector already. And typically that CVC would like to see some kind of alignment of the strategy of the company they're going to invest in with the LP, so what that means is, but they also have some characteristics of VCs. They're looking at the metrics, they're looking at a financial return. Although fit is probably sometimes more important, strategic fit is probably sometimes more important than some of the financial parameters. So I would call that a hybrid investor, and you can have them invest, you can extract value from a strategic relationship without being tied, it's somewhat decoupled from the actual strategic company. So that can be a good option. Another one is a bit like your experience with ThinkCo, John, and that's a holding company where they may have more than one company in the sector. So, there's a strategic interest, but it's not sort of one-on-one with an actual investing from a company's balance sheet that that is the actual strategic. So it's also somewhat decoupled. I mean, if I take ThinkCo, where you had BHL invest, they also are shareholders in Minster Law, Budget Insurance, and Compare the Market. And as a result, you can imagine all sorts of synergies, right? So what we find with strategics at an early stage is you've got a good chance of getting better terms than your classic VC, and you've got more potential for value add. So we'd encourage insurtechs to think about strategics earlier on,